Thank you very much for that. 3.5% down on Power Grid. Let's talk about the market setup and where we are headed. Rupesh Patel, Senior Fund Manager, Equity Investments at Nippon, is now with us. Rupesh, afternoon, and thanks so much for joining in. Wanted to get your thoughts in on IT first. In the two funds that you manage, one of them is the Mid-Cap Fund, and you also manage the India Tax Saver Fund. I see that you have holdings in IT, but you've gravitated towards an Infosys and Persistent. So just broadly, if you could explain that despite a weak showing in the current quarter by TCS and HCL Tech, and we've got EPS downgrades, what explains the up move that we're seeing right now? What's the buy side talking about? The long only funds, hedge funds, what are they saying?
So thank you so much for having me on the show. So no doubt IT, very difficult to comment on a single day's move. But if we look at results which have been reported, and though early days in the season, but very clearly we are seeing that there is slowdown in terms of demand across verticals, across geographies, and to some extent it was expected as well. Now, going ahead, we believe that this slowdown because of the macro uncertainty, and we have heard it in management commentaries as well, that it's very difficult to have a very bullish view on growth coming there. So if we look at last 6-8 months or almost close to a year, we have seen that earnings estimates have been consistently revised downwards, and some of the froth which was there in valuations, that has also corrected. So as of now, if you look at our portfolios, we are underweight information technology sector per se, and our exposure is restricted to one or two large names in one fund, or in case of mid-cap fund, where the approach is more bottom-up. There are exposures, but they are more based on the growth prospects for individual companies. But in terms of sectoral stance, we have underweight, and we continue to maintain our underweight position as of now. Going ahead, I believe that, at certain point when we believe that valuations would start looking reasonable, and that's when we would consider reducing our underweight on the sector.
All right. Hi, Rupesh. Good afternoon. Thanks so much for joining in. Rupesh, I was looking through your holdings, and I wanted to ask you about the real estate space. The verdict out there is split. One says we're maybe at the start, year 2 of the big run that we like to see in real estate after almost 10 years of no movement. What's your view on it? And I notice, I think you have Prestige Estates as well. And suddenly we're having some adverse news that came in there. The management came on CNBC-TV18. They clarified, no, there's no such news. So how will you position yourself? Will you looking at adding on some of these counters?
So again, difficult to comment on individual names, but as far as the view on sector is concerned, as you rightly pointed out, this is a sector which has gone nowhere in last 10-12 years or so. During this period, thanks to some of the developments like RERA, GST, we have seen consolidation happening, and a lot of weaker players are actually out of the market. NBFC crisis also played a role to some extent in accelerating consolidation in the sector. Today, where we are very clearly, we have seen that in last few quarters, demand has picked up. Inventory levels across most of micro markets have come down, and we have seen some price uptick also happening. Going ahead, we believe, I think it's an interesting sector to be in, but I always believe that real estate is a very micro market driven sector, wherein dynamics can vary significantly from a micro market, or from a city to another city. Hence, you have to look a very bottom up view on some of these names. Continue to maintain constructive view on the sector.
Okay, got that. Rupen, hi, good afternoon. Just want to get your sense on banks, lenders basically, and what you would still be comfortable buying right now. NBFCs, private sector banks, PSU banks, where do you think the best opportunities lie?
In our portfolios, we have exposure to banks, NBFCs, Within that, we have exposure to private sector banks as well as select public sector banks as well. We believe as far as banking sector is concerned, no doubt in very near term, it is expected that there will be some pressure on margins because eventually the cost of deposits will catch up with the increase in interest rates which we have seen, and we may not see corresponding increase in lending rates, thereby margins coming under some kind of pressure. But we believe that it's still manageable for most of these large banks because they have a pretty good retail franchisee. If we talk about growth, despite this margin compression which is expected, most of the banks are expected to report a strong growth in their NII. Credit costs continue to remain benign, and valuations in overall context of the market, they continue to remain reasonable. So we have a view that banks are in our portfolio, they are overweight and they will continue to remain overweight as of now. On NBFCs, we have seen a big move happening in last few months. No doubt some of the expectations over there in terms of going ahead with interest costs coming down, maybe their cost of funds should improve and thereby margins expanding. But we believe that risk reward after this run up is not as attractive as it was probably a couple of months back.
Rupesh, in the FMCG pack, I see that you have HUL in one of your funds. Now, ITC has outperformed HUL by quite a margin in the recent past. What have you made of ITC versus HUL, and how do you see both these two progressing over the next 12 to 18 months?
So again, difficult to make a call on individual stocks, but in our portfolio, we are underweight on staples. Because very clearly the demand headwinds which were there on account of slowdown both in rural as well as urban markets owing to higher inflation, that continues to remain there. We should see some respite on the margin side with commodity prices correcting. Some of the benefits should be visible in certain categories, whereas again it cannot be said across the board because there are certain categories like milk prices haven't yet come off. But net, I think with the inflation coming down, we should see some support on the margin side. But we believe that staples are not, likely to be in high growth trajectory. So we have some weight, some exposure to these names, but it's more to balance out overall portfolio.
All right, Rupesh, final question before we let you go. As we were having this chat itself, there were some more order wins from the defense space that came about. You have some exposure out there. What's your view from here on? I think you all would have added these stocks a little bit earlier, and some of them have gone blasted. To put it simply, the defense stocks have been on the offense. But how much of the good news is already in the price?
That's a good question and right observation that we were a bit early on some of these names, and that has worked wonders for our portfolios. And very clearly, it's driven by significant uptick in their order book. So visibility in order book, driving visibility in earnings growth, and the valuations to begin with were very, very cheap. And that has been the prime reason these stocks have delivered so well. We, as of now, continue to hold on to our position. Going ahead, the important thing to watch out for would be conversion of these order books into revenue. So the execution needs to be watched out for. And we also need to watch out on what happens to the balance sheets, because as these orders will come into execution, we will see some expansion in balance sheets as well. So working capital, to what extent it expands, that's another thing which we'll have to watch out for going ahead.
Okay, got that, Rupesh. We will leave it on that note for this afternoon. Thank you very much for joining in. Pleasure having you on the show today. Time for a